This is NewsDesk. I'm your host, Jason Miller, here with a special guest today, Nicole Foss. Nicole is world-renowned economist, lecturer, and author. And Nicole is with us here at our studios in Madison, Wisconsin. Thanks for being here.
Thank you very much for having me.
Nicole was one of a small group of economists that correctly predicted the 2008 recession and the U.S. housing bubble. She's followed closely by investors and the media worldwide. Nicole, give us a rundown, if you would, on your website, which is Automatic Earth Blogspot.
.blogspot.com. We will be changing to the automaticearth.org sometime early in this year so that we can offer more functionality. But basically, we are primarily known as a finance website. We focus on finance because the time frame is shortest, but we also cover energy and geopolitics and a wide range of other things. We're really big picture people.
Now, I understand it's quite a popular website, number 6 in the world as far as economic websites. Is that right?
In terms of traffic, as far as we know, not all the websites have their traffic counters public, but we are a major one.
Excellent. All right, well, let's get started. First up is discuss, if you would, the status of the U.S. economy. Where are we at now and how things look for the next couple of years?
We're at the end of a bubble. The housing bubble burst in 2006. We had phase 1 of the credit crunch from 2007, end of 2007 to early 2009. We then had reflation. Now, on May 2nd this year, the trends changed again. We're now moving into phase 2 of the credit crunch. So it's been going on for a period of time. There was a sense that we were getting all back to normal, that the rally was the beginning of a new bull market, but it really isn't. That was merely an interlude of kicking the can down the road a little ways, but they're more or less out of road. So now we're going to be dealing with phase 2 of the credit crunch, and this is where we really get to find out what a credit crunch genuinely means, when there is not much credit available, or perhaps any from the point of view of ordinary people. And where finance leads, the real economy will follow. This is one reason that I'm so interested in following markets, and especially the availability of credit. The ebb and flow of liquidity, which reflects confidence, drives so many aspects of the real economy, some months with a delay. So what's happening is, as the liquidity is being drained out of the economy, you're going to start to see real businesses start to suffer a lot more like they were doing in 2008. So we've had a bit of a breather, but now we are moving into a fairly intense crunch phase. It's going to be worse than 2008. The availability of credit will be worse. Interest rates for ordinary people will be higher because interest rates are a risk premium. So although government interest rates are low, the spreads are going to get much, much larger, distinguishing between risky and non-risky debt, or perceived risky and non-risky debt. So it's going to get much harder for ordinary people to borrow money. People don't save very much money anymore. Their credit card balance is their rainy day fund. What we saw in 2008 was that people were having their credit limits cut unilaterally. They couldn't borrow against homes anymore, so the home ATM was turned off. And we're going to see that only more so. We could even see bank holidays as a result of the contagion from Europe, possibly this year. So there are some very significant consequences coming down the line for people, for businesses. We're going to continue to see asset prices fall very, very sharply. Homes are nowhere near a bottom. We haven't even seen the collapse in commercial real estate yet. Stocks have a very long way to go to the downside. An awful lot of bonds will as well, and commodities. So there really is nowhere to hide in terms of asset markets. The way to ride out a deflation is in cash for the period of the great deleveraging, which is likely to be a few years.
Well, let's talk about that. So ride out the deflationary period in safe assets. Would that be U.S. Treasury notes at this point?
Yes, basically under your own control to the extent that you possibly can. The more intermediaries there are between you and your money, the more dependent you are on the solvency of other parties. And as we saw with MF Global recently, that can be very dangerous. So if your brokerage has hypothecated the assets to someone else so that your assets are collateral for their own business, which should not happen but does, then your assets can simply be claimed in any kind of bankruptcy. So you really want to have as much control as you can. So something like Treasury Direct, your own personal account, not through a brokerage, is by far the safest way to go. And also having a certain amount of actual cash. I certainly wouldn't trust the banking system, wouldn't trust brokerages. I think people need to have as much control as they possibly can over their assets.
Well, now what if somebody has a brokerage account and in that account they have treasury notes?
It's better than a lot of other things they might have, but you're still dependent on the solvency of the brokerage. And as we saw with MF Global, that can be very, very dangerous.
Well, but what about the insurance that the brokerage houses have, like SIPC, SIPC?
I wouldn't really count on insurance to pay out during a systemic crisis. The same with FDIC. I wouldn't say that would be worth the paper it's written on at some point, because it was never meant to deal with the systemic crisis. It was meant to address one or two small failures at the margins. When you start talking about systemic problems, the insurance-based systems simply cannot deliver because they don't have an entire country's worth of money just sitting on the sidelines not doing anything to pay everybody back. So I think we're going to find that an awful lot of risks come home to roost, and a lot of the things we were depending on for security or for backup are not going to happen. I mean, with MF Global, for instance, the Chicago Mercantile Exchange did not back up the trades as they are supposed to do. They have their own shareholders now that they're beholden to. So the system that was meant to back up failures like MF Global failed to work. I think we're going to see a lot more of that.
Well, let's dive right into probably what's going to be the first disaster, which is Europe. How do you see that playing out at this point, January 2nd, 2012, which is when we're taping the show?
Basically, Europe is facing an absolute disaster. They're facing the failure of the single currency project, possibly as a knock on the political structure of the European Union as well, because of the amount of recrimination that's going to be involved. It really has been a project that was not well designed from the beginning. It was meant to give the central economies export markets by preventing the weaker economies from lowering their exchange rate. So that fixed exchange rate pinned everyone together in a way that created enormous regional disparities that could not be adjusted for. And so what you've got is a system where you can't adjust exchange rates, you can't restructure the debt without crashing the banking system. All you really have left is the imposition of austerity programs in the periphery, which is what we're seeing at the moment. But even those, all they're going to do is guarantee default because they force economic contraction. When your rate of economic growth is lower than the rate of interest you pay on your debt, you're in an exploding debt scenario. So they only guarantee default by doing this. There is so much debt in the periphery, there isn't anywhere near enough wealth in the entire world to bail out Europe. Not by a multiple is there anywhere near enough. So the debts are huge. I think we're going to start to see the European Union implode. So we're going to see either the whole thing goes all at once, or they lose some of the peripheral members first and then try and keep the core going. Personally, I don't think even that will work. Even places like Germany, their export markets will die. As soon as the peripheral markets go back to their own currency, then those currencies adjust lower. You can't export from Germany anymore. And if you've got different currencies, you go back to having to change currencies every time you do things. The trading relationships just break down. A UBS report recently estimated that the cost to European economies would be between 20 and 50% of GDP in the first year on the death of the euro. So we're talking about massive effects. And we're already seeing the interbank lending market drying up. So banks know what's on their books. They are fairly confident that the other guys' books aren't looking any better. So just like in 2008, we're starting to see interbank lending drying up. It's going to get very much harder to move money around. And what they've got is a collateral problem. So with this rehypothecation of assets, what that's about is pledging this much collateral this many times. That's basically what's been done through London, where there were no limits.
Well, but now there's those that hope that there'll be a stronger union of these European countries and that the ECB will then, in effect, print money like the Fed did here, and that will keep them solvent or together, unified. Is there any possibility of this?
I don't regard that as possible. The ECB isn't going to be in the business of printing money. It doesn't set up to quite work that way. But the main issue is that national interests are diverging from the interests of the collective. So you're already seeing a lot more bickering between different countries that are now trying to protect their national interests that much more There is no political mandate for fiscal union or for Eurobonds in the European Union, even although in the short term, the impact on, say, Germany that might be expected to pay everybody's debts would be less if they went that way than allowing the euro to collapse. I still don't regard there being any chance that they are going to get that through the domestic political machinery in Germany. And if you look at the structure, even of the core countries, these are not strong, robust economies. Many of them have massive housing bubbles, like the Netherlands, for instance. Many of them have staggeringly large amounts of financial system debt. So Belgium, just over the bailout of Dexia was 180% of Belgian GDP. So you start to get into massively too big to fail in terms of these financial institutions. When they're that large, they can simply eat the real economy for breakfast. And there are a number of European countries in that position. Germany didn't have a housing bubble, but their banks funded everybody else's. So there's almost nowhere that does not actually have fundamental structural problems. All the French banks are massively overexposed to Italian debt. They're all under pressure. Market caps have gone down by in excess of 50%. If you look at the large European banks just in the last year.
Well, now, what if some of these European countries do in Argentina? They default, just wipe out their debts. How would that scenario go?
I think that's exactly what they will do. Places on the periphery like Greece, for instance, and Portugal. I do think they're going to revert to their old currencies. But what happens when you cheat your creditors, basically, which is what it would amount to, although it is onerous debt, so I'm not saying they shouldn't do this, but when you basically do not pay your creditors, you get cut off from credit markets. You can't borrow anymore. And if you are chronically in the habit of spending more than you gather in taxes, as they all are, then what you do is you go back to your own currency and then you print it like there was no tomorrow. So I certainly wouldn't want to be sitting on a pile of new lira or new drachmas or new punts or anything like that, because there will be then no constraint on printing. Right now, the bond market constrains currency printing because when you have to borrow from abroad, if you were trying to print your currency, your interest rates would just go through the roof. It would be obvious to the bond market what you were trying to do. But if you no longer have access to international credit markets anyway, then there is no longer a constraint against printing. So currency reissue and currency printing, I think, will be a major risk in the European periphery. Very much not the risk that we're facing here in America, though.
We're speaking now with Nicole Foss, a noted economist, author, lecturer on the state of the world economy at this moment. Let me ask you this. How do you see, when do you see this probable collapse of the European Union, the euro, happening?
This year.
Really?
And it could be sooner rather than later. It depends whether it all goes at once or whether they let some parties go first. It's not at this point clear which way that would go. But I think we're going to see enormous problems possibly in the first quarter of this year. There's simply so much debt that needs to be rolled over. And I don't see that there's going to be the availability to borrow just to roll over the existing debt, which is staggeringly large.
So the rolling over, this is like, these are short-term money every 3 months or 1 month or 6 months, and it's coming this year in 2012?
Yes, there's an enormous amount of money that has to be rolled over, and I don't see there's going to be access to the markets to do that. So I think we're looking at an economic seizure. And right now, it's awfully convenient to try and blame Britain, for instance, that Britain didn't want to renegotiate the treaties to have